Xerfi Global has recently published a study on the global soft drink market. The world's thirst for non-alcoholic beverages has been rising steadily over the last 6 years in terms of both volume and value. While in 2010, around 468 billion litres of soft drinks were sold with a value of 1.54 trillion euros, in 2015, this rose to over 555 billion litres with 1.79 trillion euros. Nevertheless, behind this solid growth lies change. The makeup of the market has been shifting, with carbonated soft drink sales losing ground. While in 2010, carbonated soft drinks made up 30% of the volume of total soft drink sales worldwide, they came to generate a more moderate 26% in 2015, and their sales are expected to continue on a downward path. This move away from carbonated soft drinks reflects a general consumer preference shift, particularly on Western markets, as well as increasingly strict legislation. Growing health consciousness is pushing demand away from sodas and towards other supposedly healthier and more functional beverage categories. To add insult to injury, the industry is subject to tougher legislation as a response to heightened health concerns. Governments are increasingly limiting selling locations, maximum product sizes, and marketing. Moreover, many countries around the globe are introducing or increasing taxes on carbonated soft drinks. This shift in demand, combined with other factors, has weighed on soft drink makers' profit margins. The industry operating margin was almost 16% in 2011, but has slipped over the years to hit almost 14% in 2015, affected by slowing sales of high-margin soda drinks and the subsequent need for additional capital investments for product and brand portfolio adjustments. Matters were not helped by the more general business environment, which saw subdued global economic conditions and consumer spending, as well as increased competition from the rise of private label and new brands, put pressure on prices. Furthermore, industry margins were impacted negatively by increased currency exchange rates. Soft drink companies are therefore pulling what cards they can from up their sleeves to adapt to the market environment and are following several general strategies. Internationalization is seen, particularly on emerging markets, despite their slowdown. The coming decade will see demand in emerging markets in Asia, Latin America, and the Middle East, Africa region structurally outpace that of mature industrialized countries. To tap into this growth, beverage firms are enhancing their local presence through brand acquisitions, partnerships, and investments in overseas production facilities and distribution networks. Product portfolio expansion and adjustment to match changing consumer preferences, including customization to local tastes, are also the order of the day. Ready-to-drink, tea and coffee, functional drinks, and value-added water are the most buoyant growth segments and are at the center of operators' portfolio adjustment initiatives, which mainly focus on targeted acquisitions of specialist brands, in-house product innovation, and extensive marketing and advertising efforts to support demand. Improvements in cost efficiency are also a focus. For example, the Coca-Cola Company has decided to withdraw from bottling and distribution activities in many key markets, selling its bottling and distribution assets to local partners and other third parties, and instead is focusing on core activities such as the production of syrups and concentrates, which offer greater profits.